Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, markets look set for a cautious start early in the week on Monday. Trends in the SGX Nifty indicate a negative opening coming in for the broader index in India. Wall Street ended lower on Friday with all the three indices ending the session in negative territory. Well, in big news that we have, the UBS has decided to buy in Credit Suisse in a historic deal brokered by the government now. The all-share deal has priced Credit Suisse at around 1/4 of its closing price coming in on Friday. Yet another development, S&P cuts First Republic deeper into junk. Do note it's the second cut coming in there, says $30 billion infusion may not solve problems. Asian stocks, to an extent, have been steadied, but trade negative. There is this weekend rescue deal coming in for Credit Suisse. Needs to be seen how that stacks up overall for the market. FIIs, they have sold in shares worth around 1,766 odd crore, which marks their 7th consecutive selling session now. DIIs have bought in shares worth around 1,817 odd crore. But with this, let us get going and discuss some stocks and strategies today with Amar Deo Singh, the head advisory, Angel Broking. Good morning, Amar. Amar,
Go
ahead.
Looking at the markets, I would say the markets have been, as we've been speaking earlier, also the trend and the technical indicators, they clearly point that any pullback is more of a, I would say, a dead cat bounce, because the technical indicators for the major indices and I would say some of the major heavyweight stocks clearly show that there is more of a selling pressure. And also, if we talk about Nifty, so we did see the Nifty bounce back from almost 16,850 odd levels, but it's not able to sustain. And also the trend, the short-term technical indicators, the medium-term technical indicators, I would go and say as the long-term monthly charts also, they also clearly show that the upside seems to be capped. There is consolidation, higher levels will be sold into, and bears are having an upper, comparatively an upper hand. And yes, 16,700, 16,800, technically that's a very strong support zone for the Nifty from where we can expect a bounce back, but that's more of a temporary respite. As far as looking at Bank Nifty is concerned, Bank Nifty is also displaying similar pattern, and Bank Nifty does have very strong support coming at around 38,400, 500 levels, but below that I would say 39,000 odd levels. So clearly shows that there is selling pressure and higher levels will be sold into. But yes, if these levels are held, because what is important is that if these levels are held or they are breached, but it doesn't go much below these levels, then we could say that we are seeing some sort of semblance in the markets. But negative news flows also, and they are very crucial, which are emanating from the globe as well. That also is having an impact on the markets.
Amar, also, if you talk about the volatility index, that has cooled down a little bit with India VIX declining almost 9% in the previous odd session, given some sort of comfort to the bulls. What do you make out of this, and overall, what does the PCR right now suggest indicates of the trade setup?
Yeah, I would say that you're right there, that India VIX clearly shows that there's not too much to worry as of now in terms of there was some serious concern, because if you look at India VIX over the last 10 trading sessions or so, from almost 12, it rallied towards 17 odd levels. So that was a very roughly around 40% rally which we witnessed. So that was showing some signs of discomfort among investors, but that seems to have cooled off. But I would say that India VIX needs to be below 13 or so, then we could say that, yeah, that the fear factor is in there. Trading above 17, 18, then that definitely will be a cause of concern. As far as the what we are seeing, the put call ratio, and if you look at the data, clearly shows that there is still short covering, or we haven't seen long build up in Nifty. There was marginal long build up on Thursday, but post that we've seen short covering and short build up. So clearly shows that there's not too much of conviction in the bulls as of now to go long in a big way. So that's one of the factors that's playing on the markets.
All right, Amar. Also, with the month-long correction that has come through, do you see any opportunities there in sectors or three stock ideas which are a profitable bet right now for the viewers or the investors out there?
Yeah, I would say that among the stocks, I would look at GAIL India, because this is one stock which definitely has bucked the trend. Because you see that the markets have corrected, but the stock has really held its fort currently around 110 odd levels. And so any correction in the stock towards 105, that can be a very good buying level. Upside could be 118, 120 levels. The stop loss needs to be below the 100 mark. This is one stock because technically, if you look at it on the long-term charts, intermediate term trend, short-term trend, the stock looks extremely strong and positive. So that's one stock one can look at. The other is from the real estate pack, and that is DLF. Because what we are seeing in DLF is, again, DLF has bounced back significantly. It has really brushed off the market corrections. It did correct earlier, but it's formed a very strong base around the 340, 350 zone. Currently, it's around 375 odd levels. Sustaining above 340, 380, the stock has a potential to rally towards the 395, 400 mark. So this is one stock with a positive bias in the market. And I would say the third stock to look at is Glenmark Pharma. That is from the pharma space. That is one stock one can definitely look at, because if I look at this particular stock, what we are seeing in Glenmark Pharma is that this stock also seems to have bucked the trend. It did correct. It did correct from almost 460 levels to 420. Currently, it's around 440 at levels. So this is one stock one can look at, because technically, I wouldn't say there's too much of negative sentiment in the stock. So this is one stock any pullback can be used as a buying opportunity. Stop loss needs to be below the 420 mark, and on the upside, the target one can look at 465, 470 zone.
All right, Amar, then Glenmark Pharma and DLF is where the buying opportunity is, clearly given the charts. But in bunch of stocks that we'll be addressing this morning, it will include something in the likes of Tata Consumer Products, Vedanta, Godawari Power, Rail Vikas Nigam, apart from HDFC and HDFC Bank and Adani Group of Stock. In terms of Tata Consumer Products, they've seized the negotiation with Bisleri for strategic opportunities. They've confirmed, it hasn't entered into any definitive agreements coming in. Now, do remember that in November 2022, the company said that it's going to be evaluating various strategic opportunities for growth and expansion of its business. Now, with this, Jayanti Chauhan is is expected to steer through Bisleri now. So do keep an eye out on this one. It's a relief coming in for Tata Consumer Products on expected lines, but it's come through. Well, in terms of Vedanta, there is an expression of interest for producing in, for 25 to 50 KTPA copper plate and anode, which is, this morning we're picking up on the expression of interest for setting up that plant facility along with the operation and the maintenance facility out there. Also, we'd be looking at Rail, Vikas Nigam. That also is one counter which has emerged as the lowest bidder for the new railway line, which is an HORC project by Haryana Rail Infrastructure Development Corporation. The cost of the project is around 1,088 crore. So do keep an eye out on this one as well. In terms of Godawari Power, there is this one positive indicator coming in. The company's board has given a nod for 250 crore share buyback. This is going to be held via the tender offer route. Extremely positive coming in on this one as well. In bunch of other stocks that we'll be tracking this morning, of course, Adani Group has suspended that 34,900 crore Petchem project amidst Hindenburg fiasco. And apart from that, we're also looking in NCLT green light coming in for the merger of HDFC and HDFC Bank. So clearly big deals out there. That's the biggest M&A deal that we have seen in history, and NCLT nod coming in on that one is also expected to be a big mover out for this one. Well, in terms of the other bulk deals that we're looking at this morning, Biocon, where FPI has sold an 1.57% stake in the company, and that has happened through open market transaction at an average price of around 200.7. Now, it's not, it's at a little discount from the previous market price of around 204 per share. In terms of delivery, Vanguard has bought in 1.3 crore, 1.3%, beg your pardon, stake in the company worth around 310 crore. And for Equitas Small Finance Bank, Norges Bank there has bought in 0.9% stake, while Vanguard has bought in 0.5% stake in the company. It remains to be seen how the market opens. Overall, the trend wasn't really indicating of a positive start coming in for Indian equity markets. Remains to be seen if that weekend rescue deal has actually worked out in the favor of equity markets, or we're looking at some amount of drubbing coming in for the session. I talk about the Nifty 50 index. On Friday, ended on a positive note. Volatility was on a little comfortable position too. Now let's see how does that market open. In terms of Nifty 50 index, are we looking at losses coming in for the markets? Okay, that's clearly there. 4/10, it's 0.5% out there in early trade. 17,000 mark is also, it's flirting around that level. Remains to be seen if that crucial 17,000 mark will be held on to. So that is one level that we need to watch out for. Apart from that, let's also look at Bank Nifty index, because that's where even the selling pressure has been mounting in. Well, we are looking at 0.5%, more than 0.5% cut coming in on that one. 40,000 mark, far away from it right now, not even close to 39,500 for that matter. So yeah, so Bank Nifty also seems to be participating into the negative start coming in for the market. Also, if you look at the other sectoral indices and their performance, just to get the flavor of where the losses are coming in for Nifty IT index, that's one which is down and out with cuts of more than 1.5%. Talk about metal index, with cuts of close to almost 1% out there. So clearly losses coming in for the markets. Metal down, IT down, advances declines. Well, declines in the favor, 39 declines as compared to 11 advances. For FMCG index, it's 0.2% lost on that one as well. And mid cap 2 seems to be down and out with losses of 0.3%, along with the small cap index also, you know, the losses being in that quantum for this one as well. So clearly it's IT, metal which are taking to the chin, along with FMCG, which is also down and out. If you talk about the realty index, 0.35% lost even on that one. Banking index is clearly where the pressure is mounting out there, so do keep an eye out on that one. And apart from that, we're looking at something like an auto index, that's too down with losses of around 0.33%. And if you talk about the PSU bank, that also is down and out with cuts of more than 1% coming in for that one. Out of the list that we have, clearly in terms of the worst performers, like we rightly indicated, it was the IT index and the metal index which have taken to the chin. But with that, I'm going to toss it back to Amar and get his views on how he's seen the market open. Are the cuts more sharper than what he was expecting? And what does he make out of IT counters now? He thinks the correction is overdone right now, and that's a buying opportunity out there.
I would say the index is definitely behaving the way it was indicating. So clearly, it shows that there isn't much confidence at the buying levels, and also what we are seeing is that the buying is not sustaining across the major bellwether stocks of the index. And the index also technically is, and both Nifty and Bank Nifty, they are at around crucial support zone. So give or take 100 points on the downside. That's a major crucial zone, because if that is taken out, then we could see some real sharp correction happening. Talking about the key IT stocks, I would say first I'll talk about TCS. If I look at TCS, again, we are seeing that the trend overall has been bearish for TCS for quite some time. From almost 3,600 levels, it's around 3,100 odd levels. Yeah, on the monthly charts also, it isn't showing very strong, I would say, any positive signs. Clearly shows that the stock is in for consolidation. If we go back in time and look at the stock, so somewhere in September last year, it had made a low of around 3,000, 3,050. So 2,900, 3,000. So that's a crucial zone of support for TCS. That could be a very good buying opportunity for those from a long-term perspective. And talking about the other stocks, say Infosys. So Infosys also is behaving similar to TCS. It has got very strong support coming around the current level. So 1,350, 1,400, because this was the low that TCS had made, Infosys had made again in September last year. So clearly shows that there is a lot of support around these levels, but the trend for the major IT stocks are definitely down.
All right, Amar, in terms of the top gainers and top losers on Nifty index that we have right now, clearly we're looking at the trend now being more in the favor of defensive, something like a Dr. Reddy, DV's Lab, HUL, Titan. These are the top gainers that we have on our list. What do you make out of it, especially for something like a Dr. Reddy, which is the top gainer today?
Yeah, looking at Dr. Reddy's technically also on the charts, if you see that it seems to have found support. So pharma, if you look across the board, pharma is finding some sort of support, and Dr. Reddy is definitely one of them. Because what we are seeing on the medium-term charts clearly shows that the downside seems to be capped. Upside, I would say, yeah, if it sustains above the 4,500 mark, then it has a potential to rally towards 4,600 odd levels. But the short-term bias or the medium-term bias for Dr. Reddy's is not negative per se.
All right, in terms of losers, we have something like Adani Enterprises, Hindalco, Infy, TCS and IndusInd Bank, which are actually down and out with losses of more than 1.5%. We already spoke enough and more about IT, but what do you make out of something like an IndusInd and JSW Steel for that matter?
Yeah, if I look at JSW Steel here, what we are seeing is that steel counters also are now witnessing some sort of correction because if you look at JSW, it's currently around 660 odd levels. Technically, they're not very strong on the chart. So clearly shows that if there is a bounce back, you don't have to read too much into the bounce back. It's not likely to sustain. So if I look at the range for JSW Steel, somewhere on the downside 600, on the upside 700, 720, that's a range for JSW Steel. And the other stock which you had talked about was?
JSW Steel along with IndusInd Bank.
Yeah, so talking about IndusInd Bank, IndusInd Bank also, I would say it's around very crucial support zone because around 990,000, that's a crucial support zone. Ideally, it should take support around these levels, but technically the stock isn't very strong. It's again a sell on rallies for the stock. If it breaches the 990, 950 zone on the downside, then we could see some sharp correction further. Otherwise, I would say it could be more of a range play in IndusInd.
All right, Amar, we'll leave it at that. Thank you so much for taking out the time and speaking to us this morning, please. All right, and that's part of the show where we address the fundamental story, and there is enough and more that we can talk about with the entire CS rescue deal which has come through. And to address this and more, we've been joined by Srinivas Rao, who is the CIO of PGIM India Mutual Fund. Good morning there.
Good morning.
All right, I'm just going to ask you if you're drawing any parallels per se with what happened in 2008. There is a rescue deal which has come in for Credit Suisse, but this was also a moment coming in for 2008 where there was a rescue deal of sorts for a bank, and then 6 months later, just after that, there was this Lehman moment. Do you think if it's not really exactly the same, the history is not exactly the same, it's at least rhyming, or we close about to that level? It's just too early of a panic right now for equity markets?
Yeah, thanks. I don't think we need to connect it to or relate it to 2008. Yes, that was also a crisis, but I think that was a crisis of different level. And right now also, I think what has happened over the weekend is a big event. Swiss bank going down is not a small event by any stretch of imagination. But I don't think one need to connect to 2008. I think we are in a difficult situation right now, but it is definitely not as bad as what we have seen in 2008. So to that extent, I don't want to get into a panic zone. Yes, it is a fact that I think we've been having a one after other crisis. And the fact is, just about 2 years back, the whole world, at least the developed countries, thought that we have to live with a low interest rate regime, 0 to 2%, and from there to moving to this 5-6% in a short span, and even more worrisome is that higher for longer. The earlier belief was that we will go to 4-5% and then we will see a sharp correction in interest rates. Whereas what we are witnessing right now indicates that we will actually live with these higher interest rates for longer. I don't think most people have factored in their models, including banks, this kind of interest levels sustaining for longer, and we are witnessing the fallout of that. So while it is definitely a concern, and we are living in a relatively more volatile world, To that extent, there will be ripple effects. I think, I think it is already there in Indian markets. If you see CYTD in the last 3 months, we've seen almost $4.5 billion of selling by FIIs. So there is a flight to safety that is happening. I think it's not that it will start now. I think it has already started. And I'm looking at this coming to an end sooner than later.
All right, Mr. Rao, in 2008, there was this whole issue of lax lending which happened. And now, this time around, the issue is probably of the asset liability mismatch. So clearly, fundamentally, these two are very different from what they look like. But, if history seems to be at least the order in the way it was, because if you talk about the 16 March 2008 scenario, Bear Stearns was bought by JP Morgan. And after that, 6 months later, we saw the moment happening, the Lehman moment happening. With this, it's just to say that there is this enough panic selling which has already happened. Even for FIIs, they've been selling out. For the last 7 consecutive sessions, they've been the sellers, even if DIIs are holding up. Where do you see the traction right now? Do you think FIIs have been, they've overdone with the selling, they're exhausted? How do you see the trend right now?
So, Nickey, 2 things. So I think one is what is happening globally. I don't think there is anything positive there right now, given the way events are unfolding. Market is more worried about what is likely to happen than what has already happened. So I think Credit Suisse is a past in a matter of 1 or 2 days. But the worry now is what will happen to other banking, especially mid-sized banks in other markets. And that's what market is eagerly looking forward to, whether is there any more problem to come in the coming days and weeks. So I think to that extent, yes, there is a fair bit of turmoil, and that's what I'm saying is getting witnessed in terms of FI selling out of India. But I think we need to separate what is happening in India versus what is happening globally. I think India is definitely a safe haven in terms of both economic fundamentals and also on where our banking system is positioned. I think our banking system is right now among the best and strongest. Now, we have just come out of a very, very bad NPA cycle. And I think all credit to the regulator. As you know, 80% of loans in India are on a floating rate basis. So that takes away this concern about asset liability. So neither you have an issue of the credit, nor you have issue of the interest rates. And the growth is coming back as the fundamentals are strong. So I think that is where we need to separate what's happening globally versus what can happen in India. And to that extent, I think India, we are very, very strongly poised, according to me.
All right. Mr. Rao, over the past few days that we've noticed a sharp correction coming in for the equity markets, but it's capital goods and power stocks which have remained almost insulated from the recent crash, if I may so say. What do you make out of it, and are you bullish on these two?
Yeah, so I like these two. I think what we were discussing in the previous session also. So whenever there is a problem, there is a flight to more safer havens. And to that extent, sectors that are dependent on global growth, global factors will get impacted. And that's where we are seeing impact on metals and other commodity stocks, including IT, which is also dependent on global growth. Whereas, capital goods is dependent on capex that is happening in the country. We are clearly seeing a revival in manufacturing, and that manufacturing need will be supported by increased capital investment. So to that extent, companies that are catering to this segment will do well. And the second I'm saying is power is again a domestic driven sector. We are clearly witnessing a steady growth in power consumption. Overall energy consumption is growing steadily as more and more people need electricity, whether it is in terms of electricity or in terms of fuels. Given the way economy is growing, I think this is a steady growth ahead, and any sectors that are dependent more on domestic versus on global would do well. And I think when it comes to valuations, Power is a sector where I think clearly things are extremely well placed in terms of valuation, both whether it is price to earning, whether it is um, dividend yield, etc. Whereas cap goods, the cap goods are in a different category. I think the sector outlook is very positive, but one need to be extremely choosy in terms of which stocks to buy, because here I think in many stocks valuations are already factoring the growth that is ahead in the next 2-3 years. So to that extent, I think stock selection is more important when it comes to capital goods.
Sure. Let's also chat about IT sector. I would want to understand from your perspective, what do you make out of the changes which are happening on the top line level? Something like a Tech Mahindra, something like a, TCS. We had stories pouring in of how unhappy bosses have actually made it to the CEO resignations, and Tech Mahindra also hired in the former CEO of the president coming in for Infosys. So there's a bit of a rejig out there when it comes to these large cap IT names. What do you make out of it, and do you think the entire selling is overdone right now and the basket looks relatively attractive, or you think the deals, the economy in which they are operating still remains to be a cause of concern?
I would still tend to be cautious overall where we are today. But I think the way I look at these developments is, I think we've had IT sector at 2 fantastic years. Tailwinds were great. During the lockdown, there was a clear focus, thrust on digitization. Many companies were, I would say, somewhat lethargic in terms of moving to digitization. But the lockdown compelled them to look at IT and clearly spend much more on their IT digitization drive. And Indian IT companies have done a great job of capitalizing that. However, in what we are seeing in the last 6 months is, one, with the economy opening up, costs have moved up on one hand. And the other hand, in the last 6 months, what we are witnessing is a clear concern on slowdown. For IT companies, BFSI is a very, very large segment. And the BFSI has done extremely well in the last 3-4 years. I think last year was the best year for banks globally in terms of profits they made, number of deals they have done. And from there, if there is a global slowdown that we are witnessing, it is only natural that the banking sector will have slowdown. And if they slow down, they will actually they need to cut on expenses, whether it is people and including IT. We are just started witnessing that when job cuts are announced, it's only a matter of time before we will also see cuts happening in other areas. And that's the worry that one has on the IT sector. So markets are not about today, markets are about future. And in that future, there is a clear uncertainty on whether growth rates will come down to 2-4% or will remain at 8-9%. I'm more in the camp that I think near term we will see more negative news, and I don't think all that negative news is priced in. If you look at the current valuations, so large cap IT names, yes, we've seen a correction, but even today, they are trading at a reasonable premium to their own 10-year average. To that extent, I will remain cautious on IT sector.
That's actually true. They are trading at a significant premium coming in for their 12-year average. If you talk about the TCS, Infosys, Wipro, Tech Mahindra, something like that, all of them have been trading at a significant premium, at least to a range of around 10 to 20% per se. But within the basket, if I may so ask, even after given the premium, Tech Mahindra, that has corrected a little bit when it comes to its own valuation, that we'd say. Not in comparison to probably the long-term averages, but from where it was previously, it was one of the top losers that we had overall for the year. Do you think that stock at this point of time looks relatively better, in terms of the valuation or in terms of the earning potential, or you'd like to keep your hands off and probably go for mid-cap IT stocks where, probably the premium is there, but seems to be a little better idea? How do you look at it overall?
No, I don't want to comment on individual stocks. But if you look at our portfolios, so we have stocks where we think companies have a diversified portfolio. So what is that market is looking at? The moment you are dependent more on one sector, whether it is telecom or BFSI, and then I think the premium needs to be lower versus a diversified player. So I think that's what makes sense. And the second is large cap versus mid cap IT companies. Here again, my preference is for large cap. That is also because mid caps actually have been trading at a premium to large caps in the last few quarters. That's on the back of higher earnings growth this mid cap IT companies have delivered. But I think in an environment which is as volatile as today, I would prefer to be with large caps, I think, as they are relatively safer.
Okay, your word also on the telecom sector per se. There is this entire 5G data tariff war which has come through. Airtel has come up with unlimited 5G data plan. The other day we had a revision coming in on the Geo packs, tariff packs. What do you make out of it overall?
No, I think what we are witnessing there is a clear consolidation of the industry. I mean, it's what one needs to accept the fact that I think the overall ARPU, average revenue per user, was as low as 110 rupees not very long back, and now we are closer to 170, 180, and the industry is talking about this number going to 250 rupees. So one, I think we have today a lot more customers using data and telecom, and B, these customers will pay more than what they were paying just last 1, 2, 3 years ago. And there are now fewer companies than they were 3, 4 years back. As a result of all these things, we will clearly see telecom sector revenues and profitability improving. I think that is why we like telecom sector. But at the same time, this is a very, very tech-intensive sector. Just when they are recovering their investments in 4G, now they've been compelled to invest in 5G. I think if they can provide a reasonable 4G connectivity, I think that's more than enough in India for most customers. But just to stay ahead, these companies are being compelled to invest in 5G. But I think directionally now they are better placed as the profitability is getting better. So I'm positive on this sector as profitability is getting better, but one need to watch out for this investment, continued investment they have to make to stay afloat.
All right, Mr. Rao, we'll leave it at that. Thank you so much for taking out the time and speaking to us this morning.
Thank you.
All right, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching, and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for the rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.